We are live. I am joined by Jeff Snider of Alhambra Partners and Joseph Wang, Fed guy, former senior Fed trader. Jeff, Joseph, welcome to Forward Guidance Live.
Pleasure to be here. And
Yeah,
great to meet you, Jeff.
likewise. Thanks, Jack, for the invitation. And it's great to meet you, Joseph. Looking forward to the discussion here.
I'm hearing, I just heard a little bit of echo, so we'll hopefully that'll be fine. I'm really glad that we got to get you two together because both of you are renowned for your analysis of central banks, plumbing, the monetary system, but you come at it from different angles. I am hearing an echo, so I'm going to look into that. But how about I throw the first question to you, Jeff? We were just talking before we went live. Is the Russia-Ukraine is the crisis with oil prices skyrocketing, stock markets tanking, likely, its impact on inflation as well. Is that a gift to the Federal Reserve or is it a curse?
Yeah, that's a loaded question, right? And I think we were just, mentioning briefly off air before we started that, I think we have a little bit of at least I have a little bit of sympathy. Joseph maybe has a little bit more for the plight that central bankers find themselves in. Because I think, and maybe everybody agrees with me, or a lot of people agree with me, that what the position of the Fed that's in is they have enormous political pressure on them to basically, hey, you guys better start doing something about this inflation mess because it's going to, we're going to have an electoral issue in November. At the same time, we have enormous potential economic weakness building. The higher oil prices go, the more potential demand destruction. And so, I mean, again, yeah, on the one hand, you could say maybe the Fed's been let off the hook a little bit because they could blame Russia, Ukraine for possible economic weakness, and maybe they don't go as hawkish as maybe as people were anticipating a couple months ago. But as I said to Joseph, I think they're damned if they're doing, they're damned if they don't, because I think oil prices are going to go up. The economy's in bad shape either way. And so whether they hike rates or not, it may not actually matter. And they're going to get blamed either way for whatever happens.
Joseph, what? Oh, actually, I think I know why. Okay, sorry about that. Joseph, why? What do you think? Is it a gift or a curse to the Federal Reserve? Your take.
No, I agree with Jeff. I think this Fed is in a tough position. If I were Jay Powell, I would be rethinking. Maybe I don't want to be renominated. Maybe it's much better if I just ride off into the sunset. When you think about this Ukraine thing, it's a ginormous negative supply shock to the commodity sector, right? And it hurts economic conditions as well. If you're from the Fed's perspective, what you care about is full employment and stable prices. What you're doing here is you're increasing inflation and you're also increasing unemployment, weakening the economy. So it's hard to know what to do right now. Let's say you raise rates to tame inflation, then you're going to hurt your employment mandate a bit more. If you don't raise rates, then inflation is going to get even more out of control. So I think the Fed is in a really tough position. Right now, I think the market is pricing out some of the rate hikes, but still, I think most of them are still there. So that seems to be what the market is thinking.
Joseph,
Joseph,
you go ahead.
I would say I go a little bit further than that. I think the market is reevaluating how many rate hikes the Fed gets to and where they actually have to stop, and whether or not they stop long before people have been anticipating. We look at the yield curve is flattened out to the point where the 7 and 10 year are actually touching each other various days. In fact, they inverted intraday a couple of weeks ago. The 2-10 spread is down to 20 some basis points, which is, threatening that really low level where you think, we're getting into some kind of recessionary potential, maybe not, immediately, but maybe in the second half of this year into next year. And that just adds more fuel to the fire. Then you've got Eurodollar futures, which are upside down tremendously, which is basically the market saying, hey, the Fed's going to start hiking rates, but we're not really sure how far they're going to get and what's going to happen as they do so, because we're at, a significant chunk of the market is hedging against further rate hikes down the road. So the market is starting to get the sense, and it's for going back to October of last year, we're getting this skepticism building in about whether or not the Fed can actually hike rates as aggressively as had been stated beforehand.
I agree with you, Jeff. So I noted that you posted this before. There seems to be, at least until very recently, just slight inversion in the Eurodollar curve. It's moderated a bit. So that's a pretty good indication that the market thinks that the rate hike cycle is going to be pretty shallow. If you look at what it is pricing in now against what was it it was pricing in before this Russia-Ukraine, I think the terminal rate has gone down about 50 basis points. So that I think is as you mentioned, the market thinking the Fed probably is not willing or able to hike as much. For myself, though, I don't really worry about, let's say, the 2s10 spreads. I look more about the short-term interest rate futures. I think of the longer dated yield curves, at least the post GFC in the post GFC world, as more, I guess, more of an expression of policy rates of central bank policy throughout the world rather than market conditions. In a sense, I think of it as being socialized. After all, if you look at what's happening throughout the world and global bond markets are all very tightly connected, then if you have, let's say, negative rates in Japan and Europe, you're going to have a lot of people from there just coming to the US buying longer dated treasuries, not because they think that, growth and inflation are going to be great or anything or low, but simply because it's better than what they can get at home. And of course, you have quantitative easing, which I think distorts the market as well. But the short-term interest rate futures, I think, is a bit cleaner than longer dated, though not perfect.
Yeah, but you also have very close correlation between something like Eurodollar futures and that longer-term Treasury spread. Go back to 2018, for example. Eurodollar futures inverted in June of 2018 as the long-term spread started to flatten out. And remember what happened at the end of 2018? We had actual inversion in the short and long end of the curve, which matched the explosion in the inversion in Eurodollar futures. And it's not just that. I mean, you had swap spreads compressing all over again. So you had consistent signals across the marketplace, regardless of whether the Fed was in the market or not, regardless of what foreigners were buying or what they weren't buying, that expressed skepticism about the Fed's inflation and growth narrative at that time in 2018. Remember, middle of 2018, everybody was convinced inflation was going to break out. Jay Powell was going to have to be aggressive. You have the flattening yield curve as well as Eurodollar futures betting 2019 was not going to turn out that way. And of course, that's exactly how it happened, which was nothing more than a repeat of, say, the 2006 to 2007 period when Eurodollar futures inverted, the yield curve went upside down, the spreads collapsed at the long end too. So I think there's a consistent case where if you're ignoring the long-term spreads because you think QE has muddied the waters of inflation and growth expectations, I think you got to look at the correlations here because they remain pretty tight. And also, for the 2021-2022 case, the long-term yields have been falling since last March. So we're talking about yield curve flattening that's almost a year old, which predates the QE taper, predates the whole rate hike cycle and everything else. So there's been a lot of skepticism involved in the marketplace going back that far, which suggests that we're just continuing along in that direction toward lower growth and inflation expectation.
Well, if you look at where inflation is, like 6-7%, and where are yields, right? So it's hard to say that people who participate in this market are looking at growth and inflation. A lot of it really is just an expression of policy. But back to whether or not Eurodollars are a good market, I think you're right that sometimes they do get it right, but a lot of times they get it wrong as well. If you think, let's say, what happened in the post GFC world for basically the next 10 years, the Eurodollar market was always pricing in a Fed, say, terminal rate about 3-4%, and they were basically wrong for like a decade. So sometimes they get it right, and sometimes they don't. So they are not necessarily as like the be all and end all, but something to keep in mind for sure.
Well, the Eurodollar futures curve was essentially upward sloping, as it should have been. It was optimistic that maybe growth and inflation were going to come back and that interest rates had at least a plausible path back to not quite normal, but near normal up until around 2013, 2014. But then the Eurodollar futures curve changed. So I wouldn't say the Eurodollar futures was wrong. Eurodollar futures were essentially betting that maybe some things would go right enough that the long run expectation was that we could get back at least better than somewhere off the zero lower bound. But it's not so much taking the curve literally as it is changes to the curve. So you have the upward sloping Eurodollar futures curve throughout that decade, which was maybe it looked like it was the market betting on the Fed getting back toward normal. But as it changed during these various periods, like 2014, 2015, and again, 2017 and 2018, as it would flatten out, that's the signal that you really want to hang your hat on, because that was the curve saying something has changed. We were upward sloping. We were optimistic that there was a plausible path back to normalcy, but now we're not so sure. Something has changed materially where we're starting to hedge against whatever's going on in the short run. So I think the more important part of the Eurodollar curve isn't necessarily taking it literally, there's a path back to a terminal rate of 4%, but how the curve shift changes through time. And that's really, the 2018 example, as well as the current example, we have the curve flattening out and inverting. Whether or not the terminal rate was 2 or 3%, I think, almost doesn't matter. It's that right now there's a tremendous sense of skepticism about the Fed's rate hikes and why they're hiking rates and what ultimately that will mean.
And Jeff, sorry, Joseph. Jeff, you've been skeptical about how much the Fed would be able to hike. I want to hear your thinking about that. Joseph, you've kind of had the opposite view where you've said, hey, inflation's at 7.5%. Why are we still doing quantitative easing? Why is the Fed funds rate still at target rate of 0 to 25 basis points? So, Jeff, how about you shape your view about why you think the Federal Reserve could not hike as much as people were thinking? And then, Joseph, I want to get your view into there as well.
Well, I think it starts with the idea of inflation itself. Why are the CPIs rising? I don't link them at all to quantitative easing because I don't think there's any evidence why we should, nor lower interest rates because, we've seen historically speaking that low interest rates do not equate to economic growth and activity. Certainly don't correlate very well with consumer prices. So I think, consumer prices, the Fed got it right the first time when they said this is transitory. Now, I know it's March of 2022. We've been going through these CPIs up through the roof at 40-year highs for almost a year now. And people don't equate that to transitory, maybe in the, as a sort of a starting position. But in macro terms, that is that can still be temporary. And I think what happened with consumer prices, especially in the United States, is you had federal government stimulus that shifted the demand curve to the right. At the same time, the supply curve was totally inelastic, which led to this essentially a price illusion where we believe the economy is in position of overheating. I think, Joseph, correct me if I'm wrong. I think the Fed has changed its view. They still think last year was transitory supply shock factors, but now they're worried about, consumers getting normalized to high CPI rates. They're worried about the unemployment rate at 3.9%, as maybe that contributes to inflationary pressures. So I think the Fed had it right the first time, and I think they should pay attention to the markets telling them they were wrong about the second part.
So I agree with you, Jeff, actually. I don't really think quantitative easing is causing this inflation. I think it's pretty obvious, right? So you had massive quantitative easing for the past 10 years. You have massive quantitative easing in Japan as well. Quantitative easing, it doesn't have a very strong effect on inflation. What really drives inflation, in my view, and I agree with you, is fiscal spending. Fiscal spending, what you're basically doing is you're printing treasuries to buy real goods and assets, right? So obviously that demand for goods and services is going to push up inflation. But I never thought inflation was transitory, and I continue to think we are structurally inflationary because that fiscal spending, it's not going away. If you look at what the Treasury is forecasting, we're basically going to have $1 trillion deficits every year forever. And, and listen, this is
it's insane.
And this is based on current law. We're going to pass more spending. This is basically minimum $1 trillion a year. So eventually, we're going to have more free stuff. It's going to be multiple $1 trillion a year in the future. And that structural spending, that's going to drive inflation, not quantitative easing. Out of control fiscal spending, I think, is what I think that inflation will be structural.
Yeah, but the pushback against that is the Japanese case, because the Japanese did tremendous amounts of structural fiscal spending for a very, very long time in combination with zero interest rate policy, as well as the pioneering approach to quantitative easing. Is, I think we both agree that that didn't really work very much. And yet that wasn't inflationary in Japan either. I know we can make distinctions about Japan versus the US, but certainly the way the bond market is behaving and the way certain financial markets are behaving, as well as economic growth potential. You look at the CBOE's potential numbers, it looks a lot Japanese. So, I think that, what happened last year was that the federal government got involved for various reasons. We can debate about whether it was warranted or not. But I think it had a temporary impact because that's what it does. And that the impact, the shift of the demand curve to the right has already started to transition to moving back to the left a little bit, which will eventually ease inflationary pressure. So, and I think the marketplace, as you just said, Joseph, I think the market knows that fiscal deficits are going to be sky high for our lifetime. I hope not, but at least some long run range, that there's really, I mean, fiscal sanity is such a 20th century notion at this point. It's amazing. But there is a case for it to be deflationary, not necessarily structurally inflationary.
So I hear that argument about the changing fiscal impulse, basically. So we were doing, let's say, $3 trillion of deficits last year, and this year we're going to do a bit less. I actually don't, to me, when we're already at supply limits, that doesn't really matter. So because we are basically already maxed out the supply capacity of the system, so anything incrementally we add is going to be inflationary. So let's say if for example, if you're a factory and you have, you're at half capacity and then you're at maximum capacity, and then you get 1,000 orders, okay, prices are going higher. If you're going to get another 500 orders, it's less than 1,000, but it doesn't matter because you're already at capacity. So because you're at capacity, even though the incremental increase in fiscal stimulus isn't as large as it was before, you're still kind of full. So I think that, in my view, that still would be inflationary. But going back to the bond market,
well, no, before, I think that's the crux of our disagreement here is that, look, are we at capacity? And I think you look at any of the number of statistics, like industrial production in the United States, as well as outside the rest of the world, production levels barely got back to where they were in February 2020, which was already on a downturn going back to that 2018 episode we just talked about. So I would argue that there's a lot more supply potential available. And I think we're starting to see it, especially when you look at the inventory numbers lately. All the goods that were ordered last year anticipating supply and logistical problems have started to show up because that supply curve globally, think about it in terms of aggregate terms, that the supply curve has become relatively less inelastic. So I think there's more supply potential available. At the same time, the demand effects from last year are starting to wane, and the potential for those two combined is lower prices. Maybe not, not outright deflationary, but at least a deceleration in consumer prices. And again, I think that's really what these bond curves, low yields, low longer term yields are telling us since last year, is that the potential for the temporary factors involved in what happened with the consumer prices last year to wear off, diminish over time. And we're starting to see some of that.
For me, when I look at supply capacity, what I just look at is prices. When prices go higher, that tells me that supply is being maxed out. And when you look at wages, look at the price of anything really, prices seem to be going higher. So I look at that as my indication for whether or not we're at supply constraints. But just philosophically, and this is my own view, and I know many very smart people like yourself think differently. I look at markets as just people buying and selling. Like if you look at, for example, Tesla, until recently, it just went up, right? Does that mean Tesla, Elon Musk is going to sell 1,000 cars and basically take over the entire, 1 billion cars and take over the entire auto industry? Does it mean they're going to be super profitable? I mean, I don't know. Is that really what I should see when I look at the price of Tesla go over 1,000? But I think most people would just say that, it's a lot of people buying. Maybe it's, let's say, option dealers hedging. It's just people buying and selling. It's not necessarily a fundamental story about what the market thinks, how profitable Tesla will be. And I take that same logic and I apply that to the bond market. For me, the bond market isn't a special market. It's just like any other market. And I think before the GFC, you might have had more economic input. But post GFC, there's just so much other stuff in it. For me, it feels hard to take that signal out because we actually know who's in the market buying in size, right? Well, you have the Fed.
Banks. No, that's
banks and the Fed. Banks are buying trillions of it.
Yes.
Fed is buying, and you know what? China's buying. Let's say other sovereign funds are buying. Those people, they don't really care about growth and inflation. They don't care about making money, period. They just buy because, this is a risk-free counterparty. I got to buy. I have no choice. So if you have a lot of people like that in the market, you naturally are not going to get a very clear signal.
Yeah, but I think that we do have a clear signal. If you follow them closely, they correlate closely, as well as, I would agree with you about the stock market in particular. There really is no fundamental anchor to share prices. It's a fiction we all tell ourselves. Oh, there's earnings, there's cash flow. Nonsense. I mean, those are things that we tell ourselves to make ourselves believe that there's some kind of value to shares. But I don't think it's the same way about the bond market in particular, especially since it's correlated so closely to actual economic outcomes. So I do think there is a fundamental value. I think it's gotten lost in this idea that anything that's high priced must be in a bubble. Sometimes high prices actually are legitimate. And I think low bond yields, this demand for safety and liquidity, especially from the financial system, is telling us something very important about safety and liquidity. If safety and liquidity is in high demand, what does that mean systemically? And there's also, I mean, let's talk about repo collateral, for example. Whether or not banks and financial institutions want to express a view on growth of inflation, they have to pay for repo collateral. They have to pay whether it's rented, whether it's transformed, or whether they own it in their own inventory. And so if there's a supply shortage or scarcity of repo collateral, that's going to add to the price too. But it adds to the price in a very fundamental way because it's telling you something very important about the structural, monetary, therefore deflationary potential, maybe shortfall in the long run condition for growth and inflation expectations. So I think there's a fundamental view expressed in the bond market, especially since it's the deepest, most sophisticated liquid market, regardless of whether the Fed's involved in it or not, because even the Fed knows that it doesn't control interest rates. You look at any number of Fed-sponsored or academic studies about quantitative easing, and they can't come up with a link between QE buying and interest rates. As Richard Fisher said in 2011 when they were debating Operation Twist, why are we buying bonds that the market is already fleeing towards? Shouldn't we be buying bonds or assets that the market is fleeing away from? So I think there is a fundamental signal.
If I could just jump in there. So Jeff, when you say can the Federal Reserve control interest rates, which interest rates are you talking about? Are you talking about the 2-year, the 3-month, the 5-year, the 10-year, the 30-year? Because I think it depends. It does have a considerable amount of control over the short end, right?
Yeah, you would look at the 2-year Treasury, for example. That's highly influenced by short-run policy. In fact, that's really the basic. I mean, if you're going to own a 2-year Treasury, you're going to wonder what's the repo rate going to be in 2 years, because I'm not going to own a 2-year Treasury if I can get a better repo rate down the road. But then you get around to the 5-7-year, the belly of the curve, really from 7 years on out, and there's really at times not much influence at all, including the current age that we're in. The 5 and 10 year space, past the 7-year to 10 year, the long end of the Treasury, doesn't matter if the Fed's buying, if the Fed's not buying. Like now is a perfect example. We have tapering and terminating quantitative easing, yet bond prices remain stubbornly high here.
Yeah. So let me explain for the audience. When you buy a bond, you'd expect the yield to go down. So quantitative easing, you would expect bond yields to go down, and quantitative tapering, you'd expect them to go up. But actually what tends to happen is that bond yields tend to rise during quantitative easing and fall during periods of quantitative tightening. So, Joseph, how does that make sense? How does, when the Federal Reserve goes in, it plows hundreds of billions, sometimes trillions of dollars into the bond market, buying bonds, pushing the prices of bonds up, pushing the yields down? How come is it that yields rise?
No, there's a recent paper on this. So I think this kind of goes to Jeff's point. So the people there, a whole bunch of people do research on the effects of quantitative easing, and this paper does kind of meta study, and it finds that people who work at central banks thinks quantitative easing has a big impact, and people who don't work at central banks, their research shows it doesn't do anything. So
that's and also, science, right, Joseph? That's science.
And also, it has a supplement where it says that people who work at central banks who write papers that say quantitative easing does a big thing get promoted more frequently. So it's hilarious in that sense. But I think the important thing is to realize that a lot of things determine rates. It's not just what the Fed is doing. A lot of times when the Fed is buying, for example, bad things are happening. Let's say March 2020, everyone thinks the world's going to implode, so everyone flees to safety. Then the Fed starts buying, and then people realize the world is not going to end, and so yields go back higher. So there are these flight to safety, the other flows that matter as well. But fundamentally, though, the Fed owns about $5.5 trillion in treasuries. I mean, if you release that into the market, that has to have some impact on interest rates, right? Somebody has to absorb that. Or let's say that the U.S. Treasury, for example, instead of issuing a few $1 trillion in bills, decides to just issue a few $1 trillion in 10-year. That increase in supply, that has to have an impact on interest rates as well. I think the easiest way you could see this is to see just what's happening in the mortgage markets right now. So the Fed is telling you that I'm going to do aggressive quantitative tightening. In fact, maybe I'm going to sell some agency MBS. and you see agency MBS widening, you can see mortgage rates going above 4% now, and 10-year hasn't really changed. So again, just buying and selling does have a big impact on these market rates.
Yeah, but the market knows about what the market is discounting supply and demand issues as well. And it's saying, we don't care. There's other factors involved. As you said, Joseph, these markets are very sophisticated and complex. There's an intricate series of factors that go into it. And right now the market is saying, yeah, the Fed buys a little bit less MBS. Maybe that has an effect on the mortgage rate, but it isn't having an effect on the treasury rate for some reason. And I think the reason is because, as I said before, growth and inflation expectations have been diminishing for over the last year or so. And it's getting back to the whole issue about quantitative easing too, is that, the marketplace, the reason interest rates were going up as QE was introduced, for example, in the very first QE in the United States in 2009, interest rate, long-term treasury yields started to rise as soon as it was announced, because the market was saying, you're talking about the market being wrong, Joseph, the market was saying, hey, maybe this stuff is going to work. We are pricing in higher growth and inflation expectations because we have no idea if this first US QE is going to be effective. And so one of the reasons why interest rates tend to, or sometimes behave contrary to how it's supposed to go, is because sometimes the market actually thinks the stuff will work and sometimes it thinks it doesn't. A perfect example is the 2013 so-called taper tantrum, which my podcast co-host Emil Kalinowski correctly says it was a taper celebration. That was the market saying, Ben Bernanke, you're right. We think maybe this recovery is actually happening. So we're going to sell safe and liquid instruments, because why would we own safe and liquid instruments during a recovery scenario? But that didn't last, because by September of 2013, it became clear, at least in the marketplace, that in the broader bond marketplace, that wasn't happening, that the global economy wasn't recovering, was another false dawn, and there was another collateral squeeze. There was an emerging market, U.S. dollar crisis, any number of things that made the market reevaluate its short-run position that was in tandem with what the Fed was thinking at the time. So there's these fluctuations. Again, like I said with the Eurodollar curve, it's how the curve changes through time that actually tells us something important.
In part, it is about what market participants think. And I think, to your point about the Eurodollar curve, how it changes, from my perspective, I think of it as, so for example, right now we see this slight inversion. I think of it as a lot of people basically buying that to hedge potential catastrophe. So one of the things that so it's not so much about what the Fed will do. It's that if you have a very large portfolio of illiquid assets, and then let's say shit hits the fan, then you're going to have something to hedge that. And there's not a lot of things you can hedge it that have the good liquidity and the reliable, let's say, negative correlation to risk. But one of them is Eurodollars. So you can buy a whole bunch of Eurodollars. If everything blows up, then you're going to make money off that, even if you lose money on your liquid assets. So there's that hedging perspective that affects the curve, rather than just saying purely impact of Fed policy. Especially if you look at, let's say, vol's really high. If you go buy options and stuff like that, it's an expensive way to hedge. And,
yeah, but that's the point. The market is hedging right now, and it's not just a little bit upside down.
Then it's not
seriously upside down.
So then it's not so much of a Fed perspective, but a hedging thing. So you can't really get a clean read.
What is the hedging actually telling us? The hedging is that at some point we expect the Fed not to hike as many rates and then have to lower them. So what are we hedging against? We're hedging against a scenario that forces Jay Powell out of rate hikes and maybe into rate cuts. So that's really, if the market is agreeing and hedging against that scenario, shouldn't we pay attention to that? Because, as you said, this is the deep, sophisticated, liquid marketplace where the balance of opinion has shifted toward needing to hedge. Again, that's very 2008-ish. It's very 2018-ish. It's telling us the market is sensing something right now. It's not inverted by a little bit. It was upside down by almost 30 basis points as of today, which is an enormous inversion. And that's telling you the market is hedging against some kind of scenario. We don't know exactly what it is because we don't have a crystal ball. We can't ask every trader and poll them what it is, but there is something out there, or a combination of factors, Ukraine, oil, whatever, that the market is hedging against, that says some point the Fed's got to stop hiking rates and maybe even turn around. I think that's something we should pay attention to. That's a fundamentally valid position to take, for the market to take.
Randy's got a question I just see a question in the comments. Randy asked, what's he saying that inverted 30 basis points?
So the Eurodollar futures curve in the whites and the reds is relatively steep, although it's now inverted halfway through the reds, which means the front contracts are still pricing in rate hikes. At some point, the curve kinks and starts to go backwards against itself, which is an upside down inverted curve, which from the top, which is the June 2023 contract, to the bottom, which is about the June 2025, the spread there is minus 30 basis points, let's say, just rounding it up. So that's an enormous inversion when, again, as we said before, the Eurodollar futures curve should be upward sloping all the way from the front to back. So here we have it only upward sloping at the front, which is the market hedged at the front for imminent rate hikes, but hedged at the back against a scenario, as I said, where maybe the Fed has to stop hiking rates and even turn around. And the fact that it's upside down at all is a big warning. And that it's upside down now by 30 basis points is an even bigger warning that the market is concerned about something big happening.
Yeah, so that would 30 basis points would be greater than one hike because it's 25 basis points. So something would have to be wrong. Yeah,
I don't think you don't take it literally. You never take these prices are not predictions. I forget who made this famous quote. Eurodollar futures are not predictions. Again, it's the curve shape and the relative shape. You shouldn't see any inversion at all, but if it's inverted a little bit, if it's flat or inverted a little bit, that should get your attention. When it's inverted a lot, that should tell you that the market is hedged against some bad scenario. And not just hedged, that nobody else is taking the other side of this. That's really the important point, that the majority opinion in this market is that something bad everyone agrees on is worth hedging because nobody's arbitraging this inversion away. So the market is expressing a fundamental view of how things are evolving in 2022 that are not inflationary, that are more likely to be pain, as Joseph said at the beginning, very likely to be a tough time for Jay Powell and his confederates at the Federal Reserve.
Joseph, I want to put on a chart here. I think it's actually from Jim Bianco. It's a less sexy version of the Eurodollar curve, but it's the 2-10 spread with the blue line on the top being the difference between 10-year yield and the 2-year yield for treasuries. And it's very close to 20 basis points. So the yield curve is inverting. Normally when it inverts, a sign of danger. The Eurodollar curve having already inverted, as Jeff just said, Jeff laid out his thinking very clearly, why he thinks the yield curve is inverted. It's a sign of trouble. What is your explanation for why the yield curve has inverted or is close to inverting?
So no, I agree with Jeff about the Eurodollar curve. That is people hedging, although I think it has to do with in proportion to basically what you need to hedge. And so that kind of affects the depth of the curve. So depth of the inversion. When you look at the 10-year, though, it's a different part of the curve. It's not, let's say, inversion within the short-term interest rates within a couple of years. It's between what the 2-year is and what the 10-year is. And I still am quite skeptical about the 10-year having a lot of economic content. Because when we talk about, let's say, the market knowing something about, let's say, economic conditions, just who are these people? Who are these people that are trading the 10-year? And we kind of know a whole lot of them, right? They are people who don't care about what's happening in the economy. They are people who are buying because they have to buy. And so for me, when we just kind of know that, it's hard to say that this has a lot of economic content into it. So I look at this 10-year thing and I just say central bank policy throughout the world is keeping a very tight grip of actually keeping kind of a gravitational pull of where yields are, and it's pulling them lower. I mean, if you look at the fundamentals, it's quite hard to see why, let's say, the 10-year would be at, let's say, less than 2% when you have, as we discussed earlier, basically trillions in issuance coming on forever, and you have this huge negative supply shock where we may potentially see persistently high commodity prices. There's really no reason why you would expect inflation to be so low for the coming years.
Okay, so Joseph,
it was transitory, right?
Yeah.
I mean, that's really the argument, the counter argument.
So Joseph, I get why the yellow line that's been going up because the Fed is going to hike rates in anticipation of that. But why is the Federal Reserve's policy causing the green line, the 10-year note yield, to go down?
It looks like it's been staying about the same. What do you mean that it's going down? It seems the 10-year seems to be pretty range bound.
Yeah,
but that's the point. It shouldn't be, right? If growth and inflation expectations are rising, I mean, I know we can have the fundamental view, but the 10-year, quote unquote, should be rising. If we're heading into a structural inflationary environment, people who care about that would not be wanting to own 10-year U.S. Treasuries, safe and liquid instruments. You would be chasing some form of other nominal return. But that hasn't happened over an entire year period, regardless of the Fed's policy, because the first part of that year period, the Fed was heavily into quantitative easing, buying tons of bonds. And then in the middle, they transitioned, they're buying less bonds. So the Fed isn't into that market as much, yet the long-term yields are staying steady. In fact, the 30-year yield is less than it was a year ago, even though the Fed is no longer a big part of that marketplace. And yes, the market, I think, is well aware of the supply issue that the federal government is going to continue to issue treasuries, bills, bonds, and notes for the foreseeable future. And yet there's this persistent demand for safe and liquid assets.
Yes, exactly as you mentioned. There's a whole bunch of people in the market who want safe and liquid assets, who don't care about, let's say, having real return in the bond market. And so those people, they keep the bond market yields pretty low, even though fundamentals would indicate that they would be higher. So that is why when I look at this yield curve, I don't really see expectations for growth and inflation. I simply see supply and demand. You see a world where central banks around the world have kept yields very low and written a whole bunch of regulation forcing everyone to buy these safe and liquid assets, regardless of what they view as a return being positive or negative.
And what sort of regulation are you referring to there, Joseph?
Well,
Basel III, right?
there's Basel III, but not just that. So Basel III basically forces banks to buy a whole bunch of treasuries, which they are. But also, if you're, let's say, a pension fund or even a GSE or something like that, you have to buy liquid assets. And in practice, those are treasuries. And because you have this strong demand, like Jeff mentioned, you're buying it not because you think that the world is going to be different in 10 years. You're buying that because basically that's all you can buy.
Yeah, but HQLA requirements do not say you have to buy U.S. Treasuries. In fact, there's a whole range of HQLA assets that people would probably shake their head at, including equities, for example. A new IPO could be an HQLA asset as long as it doesn't have, a 30% drawdown in its last 10-year history. So there is nothing that says insurance companies and pension funds and banks have to hold U.S. Treasuries as HQLA. They can hold MBS, they can even hold Euro bonds, for example, of very low quality credit. So they can express fundamental differences in the HQLA portfolios that they have. They're choosing to hold U.S. Treasuries because that is dependably safe and liquid. And so I think they're expressing an opinion on safety and liquidity, whether if not it's specifically growth and inflation in that part of the market. They are expressing an opinion on safety and liquidity where they're saying, I want U.S. Treasuries because I'm not going to use my HQLA in third world or emerging market Euro bonds.
So HQLA comes in different varieties. So the treasury one is the highest quality. And you want to go below that. One step below that would be agency MBS. And that's what everyone holds, because if you go any below that, it's basically worthless. It won't help your regulatory metrics at all. So everyone in practice buys treasuries or agency MBS. Now, agency MBS, not directly a rate product, spread product, but they're closely linked with treasuries. So if you kind of buy a whole bunch of agency MBS, it has an impact on treasury rates as well. But so just, you can actually see this in the big balance sheet data. Everyone just buys treasuries and agency MBS.
Yeah, I think they need them for not just HQLA purposes, but also repo purposes. You have to have repo collateral in hand. And the fact that there's a shortage of it tells you a lot about what's going on in the monetary system, which is not good. It's fragile. It's deflationary over time. I think that's where it comes out in these long-term treasury yields. They're persistently low, not because of central bank policy, but because the monetary environment is conducive to owning safety and liquidity. If you're a bank, these are not investments, they're balance sheet tools. So yes, Joseph, to an extent, I agree with you on that point, but I think it does express some kind of fundamental value in terms of growth and inflation expectations.
Yeah, Jeff.
I mean, they don't have anything else to buy. Yeah.
Why not though? That's the issue, right? Why aren't banks not lending? Why aren't banks doing something else? Why are they only holding safe and liquid assets like U.S. Treasuries? Where are the other stuff?
No,
that's part of the story.
That's all they can buy for HQLA.
No, but
they can buy
if there was risk adjusted opportunity here, They would own enough HQLA to satisfy regulations, but they would be expanding their operations and their balance sheets in all sorts of other directions. They're not. They're only owning the HQLA, not just to their Basel III markups and to avoid any GSIB surcharges. They're doing so because they're expressing an opinion about, we don't want to expand our balance sheet for risky assets because the environment is not conducive for us to do so.
So I
For
agree
any
with
number
you
of
that banks have not been lending as much as they have, but there's a couple things to keep in mind. So post GFC, it's a lot more expensive to lend, and post GFC, because of QE, the longer term rates are a lot lower. So a lot of companies are simply just tapping the capital markets rather than going to the banks. Something else to keep in mind is that the banks, we just had this huge kind of giveaway to the business sector through the PPP loans, and that's basically $1 trillion of free money that we gave to the small businesses. And as those loans slowly roll off the bank's balance sheet as they're forgiven, it looks like the banks are loaning less, but actually they just kind of made a bunch of loans, and they got canceled by the government. So that's a little bit illusory there.
Yeah, but I'm talking more big picture, going back to 2008. There is a clear change in trend in the financial crisis, a monetary change in trend, where regardless of the short run fluctuations, the rate of change changed dramatically, and lending has all but dried up. And we live in a nonlinear world, so rate of change matters most. So if loans were growing at 10% pre-crisis, and I'm just picking the number out of the top of my head, and they're growing at 3% post-crisis, that's a massive change. That's Japanese-style change, which is telling you banks are not willing to take on risk, regardless of their HQLA requirements, regardless of Dodd-Frank. It started out right in 2007 and 2008 because they're looking at the risk-adjusted returns and doing risky behaviors, and they're saying it's not worth the risk. I'm just going to own safe and liquid assets. It satisfies regulations for me. I don't have to take any risk on my balance sheet. I don't have to take any liquidity risk, which was a lesson that many of the banks learned the hard way in the 2008 crisis. So when I'm talking about lending overall, I'm talking about the overall long-run environment, which absolutely changed in 2008, which begs the question, what was it in 2008 that made banks change their behavior? Part of it was obviously they were stupid and insane in what they were doing beforehand. And so, yeah, banks needed to be cleaned up to some extent, but to the degree that they've done so in the post-crisis era, I think points to something else entirely.
No, I agree. So in 2008, all the banks basically almost went bankrupt, right? You had the U.S. government became a major shareholder, and I think Citi and Bank of America.
It was absolutely right, Joseph. It was a wake-up call, right? I mean, Bear Stearns was talked about as some kind of success. When if you're a Wall Street bank, you're in management, you're like, oh my God. Bear Stearns was not some kind of subprime mortgage peddler. They were one of the oldest brokerage firms on the street. Very good reputation. They were not doing anything really wrong or really risky. They had extended. Yes, there was hidden leverage, but everybody had hidden leverage. They were overextended on the collateral side, which meant that tri-party repo they couldn't keep up. But the rest of the banks got the message. If Bear Stearns can get taken out, we can all get taken out. And that was to me the structural change in bank behavior, therefore money for the entire post-crisis era.
If I can just, definitely the least knowledgeable person on the stream, but I have read a few books about 2008. Wasn't the problem that Bear Stearns and the other banks were allowed to put AAA rated collateralized debt obligations on their balance sheet, and basically from a balance sheet perspective treat them as if they were treasuries. So you can lever treasuries 30-1. Oh, you can lever AAA CDOs 30-1. And as such, a decline of, I'm just gonna make numbers up, of 15% in the CDOs was greater than the entire equity capitalization. So shareholders got wiped out. Jeff, I'm curious, do you think that the regulations after the 2008 great financial crisis, such as Basel III, do you think that changed the game where they couldn't put the CDs out, they couldn't put the risky assets on, and it was just because of the regulations that they had to have treasuries? Like, did it change it somewhat? Do you think that it changed it somewhat, but your main thing is the debt and the demographics, or do you think it changed it really? It was completely ineffective.
Well, I think, the characterization of Bear Stearns was more immediate than their balance sheet potential income losses. What ended Bear Stearns' run was the fact that garbage that they used as high quality assets in the repo market got revalued by their repo counterparties, particularly JP Morgan and Tri-Party Repo, who said, I used to give you 99 cents on the dollar for this. I'm only going to give you 90 cents on the dollar. Pay me $8 billion or so as a margin call on your collateral, which Bear Stearns said, I can't get it. Now, the same thing happened to Lehman Brothers in the fall of 2008, where Lehman Brothers had the same problem. Now, Lehman tried to do something a little different by transferring a lot of customer accounts to London and therefore reusing and repledging customer accounts from the Eurodollar system outside the US. But by and large, it was the same thing. The system could not withstand the reevaluation of repo collateral that was at the deep center of the entire system. And so that part, along with the being reminded of the gross downside of being Bear Stearns or Lehman or AIG or Wachovia, all of these banks that found themselves short of collateral, that started the snowball rolling where banks changed the way they operate. In fact, they changed the way they operate down to the ground level. You know, it used to be you could get away with anything you wanted in the bank. You were working on an exotic desk, you had some idea for a derivative, you call up your manager, boom, done. In the post-crisis era, in the wake of Bear Stearns, these banks now have layers of risk management. They have compliance officers, they have accountants, they have lawyers, they have everybody looking at everything. Because why wouldn't they? The risks are so huge. So what I would say is that Bear Stearns was the aha moment. And then in the post-crisis era, it was understandable what governments were doing because they had just been shocked into the worst monetary panic since the Great Depression. And of course, they wanted to tell people and reassure people that the banks, we've cleaned it up. We fixed the problem. And so they added first Dodd-Frank and then Basel III that, you know, Joseph said it already earlier, that made balance sheet capital and balance sheet capacity that much more expensive and that much more scarce to be able to employ. So I think it was the combination of those things where the risk-adjusted behavior began the snowball, and then the regulations piled in afterward and just made it that much more difficult.
I would simplify. It's just more costly to lend because of all this regulation.
Yeah, thanks. You know, I just spent 10 minutes.
All right.
Yeah, that's basically the narrative. Yeah.
I think we wrapped a nice bow on that. Let's now move on to one of our core questions, which is, does the Federal Reserve control the dollar system? I'm not talking about dollars purely within the U.S., but the global dollar system. Jeff, you're very well known for your view on this, but Joseph, how about you answer the question first? Because does the Federal Reserve control the dollar system?
Well, the Fed has a lot of control. I mean, listen, the dollar system, as Jeff knows well, is a global system, right? You have a whole bunch of Eurodollars outside of the world, but the Fed has a lot of influence on the dollar in a couple of ways. One, of course, it's setting the short-term interest rates that has an influence on how much dollar credit is created. When you have, let's say the Fed were to raise interest rates to 100%, well, you know, that's not going to make dollars very attractive to borrow in. So that's going to limit or shrink how big the dollar system is, or you can make it very cheap. Another way the Fed has a lot of control is that it controls the dollar clearing system. So, for example, ultimately, no matter where you are in the world, when you do a dollar transaction, at some point it's settled on the books of the Federal Reserve through reserves. And so when the Fed wants to kick someone out of the dollar system, like Iran, it would say, you, banks, you can no longer clear any dollar payments if the party is involved in Iran. So then, boom, you're frozen out of the dollar system. So it has some control. It's not absolute. You can't control, for example, the quantity of dollars in the world. That, as we've learned through the Eurodollar system since the 1980s, is not possible. It controls it in some aspects, but not completely.
Jeff?
I mean, that's kind of a vague thing, though. I mean, what does he mean by control?
Yeah, there's a lot of weasel words here, Joseph. Like there's a lot of gray area. I'll grant you that. But the way I look at the Eurodollar system is, you know, some of the early literature, I think, really hit the nail on the head. You know, the first real exhaustive intergovernmental study was conducted by the BIS in 1964. Of course, they waited a decade for this to happen. But what they said was, you know, the line that's kind of stuck with me when I first read it was that these were long chains of interbank relationships. I forget the exact terminology. Interbank transactions, which extended the maturity of essentially what used to be deposit accounts into longer range, longer maturity credit assets at the ultimate borrower. And what that meant, these long chains of transactions, which I think was better described by Robert Roos in 1984 when he said, new networks of interbank relationships. And so to me, when I think of the Eurodollar system, I think of it more like a computer system or a computer network, because it's all these nodes of transactions. And in fact, in the SWIFT system, it's literally ad hoc corridors of networks that get together, they form, they vanish, they continue to go and do business. So as a computerized, or as almost a computer network, what we're really talking about isn't one bank transacting with another bank. It's one bank transacts with another bank, and then another bank, and then another bank, and then another bank, before it ultimately gets to the end credit user. And all of those steps in between create all sorts of potential downside, potential faults, potential problems, including when you get into things like repo collateral, derivatives, currency swaps, any number of ways in which these chains of liabilities, or this web of currency, or this web of computerized ledger book entry accounting can go. Because let's also remember, the Eurodollar was not something brand new. It is essentially an updated version of the old global correspondent system. So if you have a bank in London that has a customer outside the United States and it wishes to convert its liability into sterling or some other currency, it does not have to touch the U.S. It can call up its old correspondent network and say, we've been doing business since the 19th century. I know you're good for dollars. Here we go. We can do a US dollar transaction. And so that is still there underlying all of this, which has now been given a late 20th century, 21st century communications gloss, where we have all sorts of weird things like, currency swaps and repo and term repo and all, collateral transformation, collateral for collateral swaps, and all sorts of things where these chains of interbank liabilities get further and further and further removed from the Federal Reserve and become more and more and more bank-centered. So if banks have a problem down the road in these chains or these networks, this network of liabilities, it's very, very difficult for the Fed to do much about it. First of all, because the Fed has no jurisdiction whatsoever outside the U.S. boundary, which is why during the 2008 crisis, and at several times since then, it has been forced into these overseas dollar swaps, because it cannot transact with outside banks outside the United States. So in my view, this web of interbank relationships, all the weird forms that they take, from derivatives to everything else, stuff that doesn't actually go on a bank's balance sheet. It goes down in the footnotes. All of this stuff happens in ways that the Fed, I think, is, in my opinion, is really ill-suited to handle. In some ways, it's understandable. It's not really their fault. This bank system evolved outside of the traditional boundaries of money. And it was sort of like, what do we do now? We have all this stuff floating around the world and it's massive. How do we plug back into it?
I think there's so if you remember, you were just mentioning, Jeff, what happened during Bear Stearns, there was all these collateral interbank relationships and it kind of all blew up. No, that I think that fundamentally changed the system, and through that brought Basel III. And one of the things about the new system is that these interbank webs, they're a lot shorter and they're a lot smaller than they used to. What happened, I think, in the post-GFC world is that the regulators realized that having these interbank complexity isn't good, because if a bank goes under, then all those claims on that bank become worthless. You have tremendous counterparty risk. So the change was made to say, hey, instead of holding your liquidity at another bank, let's say as a Fed funds or as a repo, you hold your liquidity at the Fed. And so what happened is that all those interbank claims kind of shifted towards claims on the Fed, so that you have to hold lots of liquidity at the Fed now. And that makes the system safer, but it also gives the Fed a bit more power to monitor what's happening. So let's say you do have that client, let's say outside in the outer realms of the dollar system, and they have a deposit at a foreign bank. When that client takes those dollars to pay someone else, that foreign bank who is going to hold their dollars at a bank in the US, who in turn has an account at the Fed. And so through this chain, when that foreign corporation pays someone, ultimately at the very highest level, there's going to be an impact on the Fed's books, because that's how the payment is settled. And so that's where the Fed exerts its influence over the dollar's clearing system. And one way you can see this is what happened with BNP. They were caught to be processing payments for people to Iran in dollars, and boom, $1 billion fine. That's a lot. And so that's kind of how the Fed intimidates people into obeying the rules. I do agree it's difficult to enforce though, right? If you have a long enough chain, foreign bank, foreign client, shell company, it's really hard to know who's who. Is the ultimate counterparty someone who's sanctioned? So that gives a lot of space for evasion. But it also, which is actually part of the reason why these fines are so big, because they're hard to enforce. You got to really scare banks to not do this stuff. So I think there's both evasion difficult to control, but for the parts that the Fed does see, though, they do try to do something about it.
Yeah, Joe, I think I agree with you. I think these chains or these webs of interbank transactions have narrowed a bit. I think the argument that you and I might have is whether they've narrowed sufficiently. I mean, sufficiently is probably not the right term. Whether they've narrowed that much or that significantly, and I would argue that they haven't. Yes, they have narrowed. We see, for example, collateral reuse and repledge ratios, at least what we can determine, have definitely shrunk since 2008, which means, I mean, like, that could be a good thing because banks are doing less risky behavior and there's less risk of one problem in the chain kicking off a bunch of stuff down the road. But I still think there's enough of this intricate web out there that's long enough that it continues to keep the Federal Reserve remote, its influence at a limit, and that the banks are in the center of this. And that's why we continue to have these repeated dollar problems, regardless of the level of bank reserve, because I do believe, I agree that the interbank change or these changes, whatever you want to call them, networks, they have shrunken a bit, but I don't think they've shrunken that much.
But if the Fed is standing ready to do swap lines, though, do you think it could ever really be an issue if the Fed is just, moment that sees something's wrong, boom, unlimited swap lines?
But that was what happened in 2008, right? We had unlimited swap lines
in the
middle of September. It didn't work. It didn't do anything. We still had a global dollar panic, the likes of which we haven't seen since the 1930s. And the swap lines had been initiated all the way back to December of 2007. Yeah, they were capped at, 25 or 50 billion, I forget the number. But still, that was a lot of money back in 2007. I remember hearing about the Fed doing this overseas swap line, everybody going, oh my God, this is huge. But as it turned out, it wasn't huge. It wasn't that big. It wasn't enough to stop what happened to Bear Stearns just a couple months later. It certainly wasn't enough to stop Lehman Brothers. And remember, too, in September 2008, they didn't just uncap the swap lines. They expanded their counterparties to all sorts of other banks, not China for some reason, which boggles my mind to this day. But they expanded the swap lines everywhere, and still we had massive panic for another 6 months or so.
I think for me, I think of it as a distinction between liquidity and solvency. I think if you give swap lines, you can paper over liquidity, but we had kind of a solvency issue then. But in March 2020, I think it was purely liquidity, and so you have everything going away quite quickly. Markets rebounding again, basis narrowing, and then dollar, after spiking, going back a bit to normal. But I think back in 2007, 2008, that was definitely more of a solvency issue, and you can't throw money out of that.
Well, that's to me, it's the repo issue, the collateral issue that doesn't get solved by swap lines. And so, if we have a collateral shortage situation where we have a bunch of collateral that's being revalued, again, in March 2020 is another example. Not only did we have junk corporates, you had Eurobond spreads blowing out. At the same time, you had problems in off-the-run treasuries too, which became non-negotiable in repo. Overseas swap lines don't do much to stop that collateral problem, which is why the Fed came in. At least they'll tell you why the Fed came in and bought so many treasuries, because they thought they had to fix the treasury market, when the issue wasn't treasury, it was repo. It was repo collateral in the same respect. So in my view, 2008, like March 2020, was more liquidity, and it was liquidity in ways that the Federal Reserve is not suited. And that includes, by the way, it wasn't just swap. Remember that they had the primary dealer credit facility that came into being in, what was it, April 2008 after Bear Stearns, which, if you read the transcripts and throughout 2008, policymakers were very sanguine about the ability of the primary dealer credit facility to negotiate any further issues in collateral just a month before Lehman and the entire repo market broke down in September and October 2008. So to me, it's more about the liquidity angle in things that are not related to the traditional monetary types, repo, collateral derivatives, those kinds of balance sheet tools too.
I think everything broke, but this FX swaps and one thing fixed part of it, and the Fed purchasing fixed the collateral problem. And that was a really big problem in March, that collateral. That was basically, I think that was something we've never really seen before.
Yeah, I think that much we can probably, everything broke. There was not much really to go right at that time.
It was amazing, really, yeah.
Yeah.
Jeff, I want to turn to a question. Does cutting interest rates, does that cause inflation? And does hiking interest rates, does that stop inflation?
legitimate monetary inflation. I hate that term. Legitimate monetary inflation. No, I think, cutting interest rates or rising interest rates are supposed to signal those things, because that's really what monetary policy is about, signaling to consumers and businesses. We're cutting rates. You should think that's helpful, and therefore you should do a bunch of things, because if you believe it's accommodative, you'll act as if it is. If you think it's inflationary, then you'll start spending, investing today before prices go up. And so the theory is it should be, but in practice, it doesn't seem to work out so well in that direction, either direction, whether it's cutting rates or raising. Think about Alan Greenspan's infamous conundrum in the middle 2000s, where he was hiking rates, yet the entire housing bubble and the global economic system continued to go along regardless of those rate hikes.
Yeah, I agree. Hiking rates, it's hard to see how that impacts the real economy. Let's say going 0 to 25 basis points, 0 to 1%. Does that really affect anyone? It has a big effect on the financial markets, I think. But I mean, just in real life, it's hard to see how that matters.
And Joseph, in this instance, I think you may have a view that's even more Jeff Snider than something that Jeff Snider has, which is, Joseph, you've got a piece out
inventing terms.
Yeah, you've got a view that hiking interest rates could actually cause inflation because it stimulates bank lending. Could you explain that theory? Just run it by Jeff, and then I want to hear Jeff's take on it.
Sure. The basic theory is this. So a bank basically, it creates credit, as you know. When you have higher interest rates, it makes it more attractive to lend, right? So it makes it more attractive to create credit. If you had in the pre-GFC world, the bank would manage its liabilities in the wholesale market. So if it wanted to create credit and needed more liabilities, it could go and it could borrow, let's say, in a CD or Fed funds or something like that. In the current context, it really doesn't need to do that. If you look at if you hear what the banks are saying on their quarterly calls or look at their balance sheets, they have tremendous amounts of retail deposits. They basically don't access the wholesale funding markets anymore. And retail deposits are zero interest rate basically forever. At least that's what I've been getting in my checking account for the past 20 years. So, so basically when you raise rates, you just widen their lending margins. So that, I think, makes it more attractive to lend. And there's other aspects to this as well. For example, basically you get more IOR income. And where does the Fed get its IOR? Well, it just kind of just gives it to the banks.
Makes it up out of thin air.
Yeah, it does.
I agree with you, Joseph. I mean, that's the sound. I mean, the idea that rate cuts stimulate lending and credit, that never made sense to me either, because, you have to look at it not from the perspective of the borrower, or not just the perspective of the borrower. You've got to look at it from the perspective of the loan issuer. If you're making it less of a profitability or no profit potential to make a loan, would we really be surprised if banks don't want to do it? Yes, 100%. Maybe more people want to borrow, but banks don't want to lend.
100%.
So in theory, higher rates should stimulate borrowing. Where I would disagree is that I think banks are balance sheet constraints and other factors. But if anything might work out of all of the possibilities that we're given today, that would probably be the most likely in my view, because it's at least thinking about banking and lending and credit in the right way, which, for the longest time, it's been so upside down in the way we're taught about how to evaluate credit and money and banking and all that thing. So why not, right?
It'd be insane. Let's say the Fed starts hiking rates and then inflation just gets higher, right? That'd be so funny.
And then it becomes a spiral.
Jeff, Joseph very ably described to me the portfolio channel effect, the rebalancing effect of quantitative easing. In other words, and hiking rates. If the Federal Reserve hikes rates, that destroys value on the short end of the curve. So people who own 3-month, 1-year bills, they are worth less. So therefore their portfolio is worth less. So now they're going to sell 10-year bonds, and now they're going to sell some credit. Now they're going to sell some stocks, and sort of the portfolio losses spiral down through the asset universe. Do you? What's your thought on that theory, and do you see it in practice?
No, I think theoretically that's sort of the point, but in practice it never seems to happen, which is why interest rates always stay low. Because obviously in the T-bill market, there's use to T-bills that is not necessarily tied to investment characteristics. Again, repo collateral, the best of the best of the best. That's why we see, for example, the 4 and 8 week T-bill rates up until recently, yielding less than the RRP, because there was use and premiums and utility for T-bills above and beyond their nominal investment characteristics. So even as interest rates go higher, there's still those reasons to own those things. And I don't think it leads to a cascading effect where as bonds are revalued in price, it necessarily destroys leverage, for lack of a better term, because there are other characteristics involved in owning those assets. So, if in theory, that's what's supposed to happen, but in practice, we never seem to get that far.
I think so. This is my big thesis. What I watch in the markets right now, I watch the 10-year selling off, even when the stock market is selling off. To me, that's kind of a huge red flag. I look at the 10-year selling off because because I think it should, because you have huge commodity shock coming. You're going to have higher inflation. Well, whatever. That's a fundamental view, and I don't like having fundamental views. But what I see that though is that people who own 10-year, they're losing money there. That's supposed to be their hedge. They're losing money on the stock market. That means they're going to have to puke. So all things equal, what the Fed is doing when it's tightening monetary policy, in my view, is that it's just kind of making people who hold treasuries lose money, which forces them to sell equities. And so that I think is the mechanism in my view as to why this is not good for the stock market, for risk assets. I agree with Jeff that treasuries definitely have value as collateral, and that has to be priced in as well. It is hard though to know exactly what that price is, but
Yes.
many people have to hold that to put for derivatives, let's say, as collateral.
Yeah, thanks to the Fed, right? I mean, come on, let's get some collateral type of measures and data out there. Let's start exploring these repo spaces.
Do you think that the Fed government basically writes rules just to make sure that everyone has to buy their debt? Because I definitely got that sense in some of the regs that I see. For example, you have these GSEs.
It goes all the way back to Basel I, right? Let's prioritize sovereign government bonds and give them the lowest risk weighting so that the incentive is so huge to buy whatever governments sell forever forward.
My sense of the public sector is these people, they're not that smart. So on the one hand, I'm like, they can't possibly have thought of this. But on the other hand, it seems like that's what they're doing. So another way, maybe they really just do believe that, government very safe, you must buy your assets for your own good. Right? Maybe they just drink the Kool-Aid, I don't know. But it does seem to be like that's how they're shaping the system.
Yeah, risk parity and sort of buying stocks and buying bonds as a hedge. The 60-40 portfolio, which is the unlevered version of that really is a benchmark of portfolio theory, and it really has been challenged. I think this has been one of the worst years of the past 2 months for 60-40 in a very long time. We got talking about collateral, Jeff, that you brought up. We got a question from Harold who asks, can you talk about gold being used as collateral in repo, as Zoltan Pozsar has been talking about? Jeff, how about you take that one?
Well, to me, gold is sort of the collateral of last resort in a pinch, but it's still hard to mobilize because you have to find willing counterparties. And at times that can be very difficult. I'm thinking specifically of 2010, 2011, a lot of European banks were trying to use their stores of unencumbered or unallocated gold, and they had to swap it with the BIS because they couldn't find counterparties in size. So gold as a collateral hedge of last resort is theoretically possible, but at times it can be a practical impediment because you got somebody else on the other side.
Gold market. I don't even know where you to get that, right? I mean, are you going to have someone with an armored truck drive by, just the gold?
Yeah.
So,
can you unload 20 tons just on a moment's notice? We'll just get some bars and we'll just ship them off to some.
That stuff is really heavy. I think something about Zoltan. I think what he's saying though is that it's not liquid, definitely, like Jeff mentioned. But in a world where your reserves held somewhere else could just disappear, gold doesn't do that. It doesn't disappear, and that's a nice thing to have, right? So, what's the point of having all these super liquid things that might disappear on you one day, right? It's useless. Rather have this thing that, sure, not very liquid, but at least it's still there.
It's really your priorities, right? I mean, you look at the Russian example. The Russians decided that for the longest time they wanted to own lots of gold because of, as Joseph just said, it's counterparty risk free.
Yes.
However, it's not very liquid, and so that's why in March of 2020 the Russians decided their priorities had changed. And so they stopped buying gold because they were prioritizing the liquid assets on their reserve portfolio rather than to continue with the store of value. Now, I think they've changed their mind recently. Now they're going back to say, hey, maybe we need to prioritize counterparty risk again. But it's really, that's the tug of war. That's the tug of war that every financial institution or government institution finds itself in this environment, is store value versus medium of exchange. Which one do you have to prioritize? And it's not often easy to do so when you have these momentous problems, these momentous swings, volatility that's always it always seems to be there.
No, that's definitely true.
So yeah, I just want to ask what your view is on the Fed essentially canceling hundreds of billions of dollars of reserves that the Central Bank of Russia thought as money. I want to put up a chart that, Joseph, I know you've seen before. On the left is the composition of the Russian central bank's assets. Blue is securities, so that's European government bonds, Chinese government bonds, Treasury, U.S. Treasuries, and the like. Green is the deposits with other central banks. Yellow is gold. Gray is other deposits. What has been, as of now, 5 p.m. on Tuesday, March 8th, what does the Central Bank of Russia has access to, and what does it not? Jeff, how about you go first, and then I want to get your thoughts too, Joseph.
Well, they have the access to certain deposits held abroad with other banks. We don't know exactly who, obviously, and I don't think we ever will. I think they have tremendous counterparty, dependable counterparties in certain places around the world, whether it's China, the UAE, maybe Switzerland, and other locations. So they do have access to certain correspondent assets in those places. But I think what you saw, especially in December, was a huge shift into deposits with other official institutions, whether it be friendly central banks, maybe not the IMF or the BIS, but definitely other counterparty central banks that, let's face it, Vladimir Putin knew what was going to happen in February. And so just in their reserve composition change, they were getting prepared for being sanctioned. And I think a lot of those assets were shifted around. They sold a bunch of securities, or at least they maybe moved a bunch to Belgium for certain reasons. So they definitely changed their reserve mix, their portfolio allocations, to raise the level of dependable liquidity in their entire reserve portfolio, anticipating what was going to happen. Now, that doesn't mean they're completely insulated from sanctions or they're completely insulated from the downside. It just shows that a little bit of pre-planning that likely put a bunch of these reserves at least in what they may think is dependable places.
Joseph, I want to tee you up here because I know you wrote a piece called Breaking the System, where you use the phrase financial WMDs, weapons of mass destruction, and talking about the essentially canceling of bank deposits of the Central Bank of Russia. You talked about how future reserve managers will have to realize that money in a bank can go poof, anytime, regardless of deposit insurance, and that a much larger gold allocation is necessary as a safeguard against the existential risks posed by financial sanctions. So, is this a financial WMD moment, and why is this a financial WMD?
I would back up and say not just what happened to Russia, but look what happened in Canada, right? You have dissenting viewpoints. You know what? You don't get a bank account. So that's just not right. So it's not right. It's not smart. You're creating suspicion of the banking system. You're creating risk in assets where people thought were risk-free, and they're going to have to adjust their behavior accordingly. So if you're a sovereign and you look at what happened to Russia, that sends you a very clear message. All these reserves that I have, they might not be there if I don't listen to what these other guys are saying. If you think back to World War II, once everyone saw nuclear weapons, they suddenly felt insecure because maybe the US can come and take me over. Not just the Soviet Union at the time, but US allies too. Nobody wants to be at the mercy of someone else. And so you saw a global scramble for nuclear weapons, even among close US allies. I think you'll see the same thing today. Let's say you're China, or even if you're India, maybe you have some territorial aspirations that are very, very important to you, but not approved by the US. What are you going to do? Well, you got to be able, if you want to realize your aspirations, you got to be able to make sure that you can survive these sanctions. You look at what happened to Russia. The one good thing that Russia did was they had a whole bunch of gold, and that's protecting them. That's helping them a lot. So you kind of have to have a lot more gold as well. So what happened today, I think, when you have people breaking confidence in the system, they're going to look for alternatives outside of the system. And I think traditionally, for central banks at least, that's gold.
Well, you two have been very generous with your time. We're running on nearly 80 minutes. I guess my final question that I'd love your thoughts on are, how many rate hikes do you think the Federal Reserve will be able to do by December 2020, by New Year's, let's say? What's your base case? Jeff, I'll start with you.
Yeah, I don't even know how to answer that, because I think the situation is really so fluid that it's kind of up in the air. And again, some of it's just markets pricing, but just there's so many big things happening. We have potentially a global growth slowdown that materialized before we even got to oil prices going toward the moon, which creates any number of scenarios where the Fed has to say, well, we got political pressure to hike, so we got to start hiking, but how far can we get before we have to stop? And so, I'm very reluctant to put a number on it, because I think it could be anywhere between, it really could be between 1 and 4 or 5. When you think about the example in December of 2015, where Janet Yellen's Fed thought they were going to lift off right away, and then they kept putting it off. And then they did one in December 2015, and then there wasn't another one for an entire year because the situation had changed. And I think there's much more political pressure, much more immediacy to them starting in, 9 days from now, or whatever it is, 8 days from now. They're going to start in 8 days, but I'm very reluctant to put a number on it at this point.
I think that I'm going to take a view that's a bit out of line with the market. I think they're going to hike super aggressively, and I think they're basically staring at the greatest disaster the Fed has ever seen in some time. You're entering this rate hike cycle with 7% CPI, and you just had this tremendous negative shock. You have oil, multi-year highs. You got copper, aluminum, everything going to the moon. So this 7% CPI, it's going to get much worse. And so you're going to have to get ahead of that very aggressively. So I think that the Fed is going to be surprisingly hawkish at this next meeting. And I know that growth is slowing, and I know maybe we might be in a global economic recession because of this, but this level of inflation, it's just comically awful, and it's going to get worse. So I think they have to do something. And eventually, of course, it'll crumple down, and we'll have commodity prices come down a lot when we crash. But before that happens, there's going to be an aggressive messaging, at least.
Great. Well, that's really interesting. I guess what you're saying is because of the commodity price, it may harbor a recession. It often presages a recession, commodity price appreciation. But in the midterm, it's going to mean a huge amount of inflation. I mean, just oil at $130. So what's that going to lead? Well, Joseph, Jeff, it's been an absolute pleasure to bring you two together, to have you exchange your views. For people who are coming at this debate wanting to see a clash of the minds, I think it was a very respectful discussion. It definitely was not a angry debate at all. So I was really glad that you could exchange your views in such a nice way. And it sounds like you guys agreed on more than people thought.
Yeah, imagine that, right? We have a nice, sane conversation. We find out, maybe we disagree on some big issues, but boy, I bet there's a lot we do agree on. It was a pleasure. Thank you for the invitation, Jack, and Joseph. It was a pleasure meeting you and discussing things too. And let's do it again sometime.
Absolutely, it's great meeting you, and thanks so much for putting this together, Jack. It was great.
Would love that. Thank you, everyone, for watching. Please make sure to subscribe to the Blockworks YouTube channel. Subscribe to Joseph Wang on Twitter at FedGuy12. Subscribe to Jeff Snider at JeffSnider_AIP. And Jeff, by the way, the reason that we agreed, you and Joseph agreed so much is because I sort of held back. I asked the easy question. Next time, I'm going to ask the question such as, are bank reserves money? And Joseph's going to say yes. And you're going to be like, Wonderful. Well, right. Thank you both, and thank you, everyone, for watching.
Bye.